Access to this webinar is for educational and informational purposes only. Consult a licensed broker, registered investment advisor before placing any trades. All securities and orders discussed to track and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. NFLX.com, TSW, nor its affiliates, nor any of their respective offices, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotion material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Jeez, especially this month. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. TSW provides education and training services and are meant to teach you the risks and potential rewards of trading options. And we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. Fantastic. Got that out of the way with great ease. Now, all right, everybody's good. We can see what's going on, and it's horrible. This doesn't even begin to convey the horror that is going on in the markets right now. But, look, this is good. Markets sell off. Normal markets have corrections. And this is a correction. We haven't had one in so long. We forget like it's supposed to happen. It's a perfectly normal part of playing the stock market. Everybody's like completely freaked out, but this is good for, I can't believe we missed this one, 4,000 on the NASDAQ. That's 20% below 5,000 people. If you don't play that for a bounce, why would you not be liquid? Right? 1,800 on the S&P. If you're not playing these things for bounces, why would you have a penny in the market? 16,000 on the Nikkei. What a great round number. 16,000 here, 4,000 here, 1,800 here. These are fantastic numbers to play. If you're not going to go long there, you shouldn't be in the market at all. Okay? I mean, seriously, it's like, why would you have any longs if you don't think those are good buys? Let's see if we can find a bigger picture to look at. Yeah, back to this one, FinViz. All right, so here's the daily view. This is pretty catastrophic, right? You look at these things daily, and you're like, oh my God, we're down from 17.5 to 15.5. That's 2,000 points. Do we have a handy-dandy calculator? All right, so 2,000 divided by 17.5 is 11%. All right, but I mean, the market corrects 11% all the time. Let's look at a monthly view. Okay, here we go. Here's an 11% correction or something like it, right? There you go. In fact, proportionally, I imagine this was bigger than 11% correction. But here's a nice correction, and up we zoom. You see, the monthly doesn't even cover it. I'm going to have to go to Yahoo to show you guys what I'm talking about. This is the big picture. Linear, log, linear, log. Oh, that's not what I meant to do. There you go, candle. Okay, and we're going to go max. Now, on the one hand, this is nothing. This is a pretty normal correction. They happen all the time. Here, on the way up, here's a big correction, here's a big correction, and finally, here's a big correction. We've been waiting for one of these. In fact, we've been calling a top all this time. This is I don't even know what these are. These months? September, January. No, these are quarters. So here's September of 2014. Here's the entire year of 2015. And I spent this entire year being a big stick in the mud above this 2100, at the 2100 line. Because I kept saying, I'm sorry, these stocks aren't worth 2,100. What are they worth? They're worth 1,850. I can swallow 1,850. I can't swallow 2,100. But 1,850 is still our middle line. That's where we consider a fair value. And that means it's not a very big deal if things fall 10% below here. So that's going to be another 180 off. So figure, call it 2,000 off. You're talking about, about 16,000. So somewhere around here at these tops could be the bottom. If things break down here, we could easily go this far down. But this isn't a panicky thing. It's a buying opportunity. But the problem is, here's the problem. In fact, I'm going to show you where the problem is using our own mistake. Unfortunately, see, here's the short-term portfolio. This is not a problem. This is a balanced portfolio approach that we use. Our short-term portfolio is bearish on the market, generally bearish on the market. We're always looking for a short-term trading opportunity. We don't care if it's bullish or bearish. But on a bias, we're always going to look for things that are bearish to offset the long-term portfolio. So here's what we did right, is we're up 300% in this portfolio, 400,000, let's call it market value, right? Starting from $100,000. That offsets the losses in our bullish long-term portfolio. Look at that. Now up only 5%. Now, this is completely nonsense. It's because of the VIX and all that. I mean, it's not really. It was up 15, 20. No, it was up 20-something yesterday. Let's say 15 to 20 yesterday. So it's lost 10% today. Now, part of the reason it's lost a lot in the last couple of days, though, is because we were being protected by a Netflix trade where we shorted Netflix and made about $30-something thousand on that. Now that came off the table on Friday. It expired, and that leaves us without a big net short in this portfolio. So now we're losing ground faster than we were previously. Bottom line on long-term portfolio, 525 in cash. So 525 plus 400 in the other portfolio is 925. That's down from $1 million. But still not so terrible considering the market took a complete powder. All right, and also, again, like I said, a lot of these are really inflated because we sell so many puts in this portfolio. Well, in fact, here you go. Look at our value. The value of our holdings is negative $364,000. But because we have a balanced portfolio, there's very little loss. From S&P 2100, where I wanted to cash out, but we didn't cash specifically didn't cash out to show how this experiment works, how if you use one portfolio to hedge the other portfolio, when you balance your positions, you can maintain even in a down market. That was the point of not cashing out this portfolio. I wanted to just go to zero and wait. So just so we all know that, I was very adamant that if it was real money, I would have gone to zero because there's no reason to stay in this market. It's just too messy. Anyhow, so here we did the right. Although we didn't cash out, we balanced ourselves well enough where there's very little effect on the net balance, even in this disastrous sell-off that we've had in January so far. So from S&P 2100 to S&P 1850, which is a 10% correction. I mean, yes, our portfolio has gone down almost 10%, but it's very manageable. I mean, our total portfolio value has gone down almost 10%, but we leave ourselves with a huge amount of cash in the short-term portfolio. I think, well, here you see we have more cash than positions here. Because we sold a lot of puts. So we have tons and tons of cash. We're using a good amount of margin now because the margin requirements are creeping up on us. But our buying power, well, this is our buying power if you were like in an IRA. It doesn't give you the double margin. It only gives you one time. So we really have like 800,000, half our buying power is left. In the short-term portfolio, so the buying power should be double what it lets you have here. In the short-term portfolio, we barely have any positions left now. And we've got all cash. I mean, it's essentially all cash. These positions are only minus 17,000, so we could snap our fingers and get rid of those and have $400,000 in cash. And what do we use that money for? We use that money to buy long-term positions. They're cheap. Okay, it's very, very different when you don't have cash and you're trapped in a lot of positions, and I'll show you where that's happening, unfortunately, in our 5% portfolio. It is now down today. It was down 30% yesterday. Now it's down 43%. That is really horrific, okay? We've got, it's more than all cash because we have, we made money in the past and we put that in cash. We had other things. It's all these positions. It's this minus 72,000 in positions that is just simply killing us. But we just did a review the other day. There's really not positions we don't like. Our biggest problem here is this one. We have a negative $20,000 right in this position. So 20% of this loss is caused by these SQQs. And boy, did we pick the wrong time to go long on the SQQ. We have we'll be able to roll out of it. I'm not really worried about the problem. But here's a portfolio where we stayed generally bullish and the market turned on us. And that's the kind of damage it did, as opposed to the LTP, STP balance strategy that we used over there. Okay? So this portfolio will recover over time, assuming we don't have another 10% drop. But what we're going to have to do now is, here's the logic. Because we are down 40%, we don't want to go down more than 50%. We're going to have to take 5% or so of our portfolio, $5,000, and make a $25,000 hedge, like the one we just put in the short-term portfolio on SDS. Because if the market drops another 10%, we cannot afford to be down 90%. Okay, obviously. So we need a 50% hedge. So if the market does drop another 50%, we're going to stay even and be okay. We'll be able to then start buying more and doubling down. If the market goes up, instead of recovering our 40%, though, we're going to lose the 5% because these are very aggressive hedges, and we'll only recover to 95%. But you know what? When you're down 43%, getting back 95% of your money sounds really good. So that's where we're going to be. I apologize to people who picked up this portfolio at the wrong time. We were doing fantastically, and we got a little too cocky. We bought more positions, and then the market completely collapsed. And worst of all, this is my fault entirely, though. We left this thing naked, and that's what really crushed us. Because being down 20% in this market wouldn't be a big deal. It's this thing that's killing us. All right? And we can work out of it. We will work out of it. But unfortunately, it's going to be harder to turn around. So that's where we are now. Let's see if we have any questions. Tom says that we doomed. Well, this is what I call doom. I mean, down 10% is doomed. And now it's not just that we're down 10%, it's that we have the very big possibility that we could be down 20%. In fact, what time is it? Oh, obviously, I'm trying to watch all these different markets. See where Europe finished. Holy crap. Europe finished down 3.5% roughly. So Europe finished down about 3.5% today. We're down about 3% today. It's a total mess. Really horrible. So yeah, I think I unfortunately, because the problem was the long-term. Oh, I mean, while we were looking at portfolios, let's look at how the butterfly is doing. That's another balanced portfolio. This is a self-balancing portfolio. We have the butterfly portfolio. And that took a hit too. That was up 80%. It's down 15% now. I mean, you can't help it. When things swing this wildly, they go against you. But look, it evens out over time. If you can't go by, this is right now the worst case scenario at the moment. It's just swung so far down in a month that it blew out a lot of our position. But still, because this is balanced, which unfortunately the 5% portfolio is not balanced, because this is balanced, it takes a relatively minor hit. But this is what I mean by being either balanced or in cash, because if you're not balanced or in cash, this is what happens to you. This was a generally bullish portfolio. It wasn't using a wholly balanced approach, and the bullish positions are getting clobbered. And I really, I'm going to work very hard to see what we can do about getting this thing back. It's very... It's going to be, I will look, I mean, we have to hang our hats on the market coming back to some extent, and that's not looking that promising at the moment. I mean, look at these long-term charts. These are the monthlies. If we start blowing this now, the thing, as you know, I'm not a chart guy. So I care more about the values. And last Thursday we looked at the values of the Dow, and we said the Dow's kind of fairly valued here. But we're in a panic, and a panic can knock you down 10% from anything. It's very easy for the markets to panic down 10%. So all you can do really is basically, if you're in positions now and they're hurting, all you can do is put on some covers and then grit your teeth and just ride out the damages, okay? But those covers have to be sensible and enough of a cover that you can ride it out. You can't do a 2008 where everybody thought this was going to be better, then it went down further, then people said, well, now I've lost half my money, what do I do next? And they said, well, let's hope for a bounce, and it went down here, and they said, oh, now I lost 75% of my money, what do we do next? And they said, well, nothing you can do but wait, and then you go down to here, and now you said, oh, well, now I've lost all my money. You know, and then the market comes back after you've lost all your money. You know, that's not what we want. So you have to make sure you have a plan, and if you don't have a good plan, if you can't execute a good plan, you are better off cashing out. You can't just ride these things down. Because even in 2008, if you could cash out with a 50% loss, and then you got back in after the market dropped another 50%, you could have done very well. Because we're up like 300% since then. But you have to have something to play with. Otherwise, you're just screwed. Like I'm sure a lot of you guys had, you know, IRAs or 401ks, the kind of things where you just have a bunch of ETFs and you don't care and whatever. And then one day you looked in 2008, you see, oh my God, my balance is down 50%. But then if you didn't touch it a couple of years later, you're like, oh, it's all back. I said, you know, as long as you don't obsess over it, it's a crappy couple of years if you're staring at it all the time. But realistically, it's just a market cycle. And what I go by looking at these values, you know, looking at this value and this value and this value, it's earnings. The earnings are proving out. If you, what else gives you back 10 times on, you know, not 10% on your money? A lot of these corporations, these lowball numbers now with these companies, you buy a company, they're earning 10% as much money as you give them every year. That's a lot. So when you get companies with P's of 10 and you still don't want to buy them, you're probably missing opportunities. All right, catch up on questions. John says, I'm not as worried about the correction in the markets. I'm worried about contagion spreading. Yes, that's what we're worried about, and that can take us down because if they really start falling apart, that can knock us down. You know, our beloved leaders are meeting in Davos right now, and they're discussing the situation. The Fed is going to make an announcement next Wednesday, so we'll get an announcement from them. Obviously, they're not going to be tightening on Wednesday. I don't think it's possible that they'll ease. It is possible the Fed's going to say, you know what, we made a mistake, the economy's weaker than we thought, we're rolling back that rate cut. It doesn't make them look stupid because they're just reacting to what happened since the last meeting. So they do have the possibility of doing that. And really, a lot of this is about oil. Oil is completely bottoming out right now. In fact, at this moment, it's $27.69. Hang on a second. There's two oils. There's two oils trading today that are important. The first contract is gone. CLG 6. Wow. So the front month contract, people were stuck with the February oil contract, and now it's just a disaster. There's so much oil flooding the market that those February contracts are worthless. They're down to 26.22. People just cannot get rid of these contracts fast enough. Now that's bringing down the price of the March contracts, which are now 27.72. So this morning we took a poke at playing them. That didn't work. So this morning we tried to take a poke along at CLH6, the March contracts on oil. That didn't work. Now it's down to 27.69. At 27.50, I like them again for another poke. We'll try it again. In fact, I mean, really, it's so close I can do it now. Gasoline, too, at touching $1 is another long, the RB contracts. Let's see. Right, so anyway, so oil is dragging everything down. The energy sector is down like 5% or 6% today. That's a complete wipeout. And that then drags the banks down, because now everybody's worried the banks are going to, the energy sector is going to go bankrupt and cause bank problems. So oils and energy, yeah, down 5%. Basic materials down 2.5%. Transport's down 2%. Industrials are down 1.6%. Construction down 1.6%. But you have to understand this. If you look at utilities, first of all, utilities are up 1%. Consumer staples, flat. Finance down 0.5 point. Business service down 0.5 point. Retail down 0.6. Consumer discretionary 0.6. Not everything is falling. Energy and materials are falling and dragging stuff down with it that have to do with construction materials, transportation, whatever. But the actual running economy, the consumer economy, which is most of the economy, is fine. In America anyway. And that's good. This is a good sign because not everything is selling off right now. It seems like it is, but it's not. You got to pay attention to where we are. Oh, in fact, here's a heat map. Where is that? Oh, yeah, here. I know somewhere there is one. Maps. Is that what I mean? There you go. Well, that doesn't make it look good. Because obviously nothing's going to be green. It's going to be less red. I don't know. Anyway, I'm looking at the sector performance chart. Oh, wait. Oh, here you go. New screen and portfolio groups. Okay, see basic materials, financials, utilities. Oh, actually things turned worse since the other one I was looking at. But technology, consumer goods, conglomerates, healthcare. And here you go, overall utilities, healthcare. It's these basic materials that are just killing us. Killing. Conglomerates killing. Because why? Conglomerates work with the basic materials companies, so they're killing. The financials lend money to these guys. They're getting killed. And services include the oil services. So that's why they look terrible, right? And then industrial goods supply the goods to these guys who are getting killed. It's all connected. But it's really all based on this industrial recession we're having where goods and services are not being produced. And that's a problem. So why is JP Morgan down? Everybody's down on fear. Everybody's down on fear of going forward. That doesn't matter how good things are or how good things were. It matters that the world is collapsing and soon we're all going to be living in caves again and we're all going to be trading and bartering stones or bitcoins or whatever instead of cash. It's back to that mentality that we had in 2008, which is it's silly. But you can't, just because it's silly doesn't mean it's not going to affect the market. So yeah, there are big concerns about any financial. And by the way, if everything gets worse, if oil goes to 20 and flatlines at 20, and oil companies start going bankrupt, then that of course spills over to the banks. They have to write off billions of dollars in loans. They're going to take massive losses, so on and so forth. That can take a year, 2 years to unravel. So not without reason. And the problem is, look, we went to cash. We went to cash when these things were worth something. Everybody now, and this is again the reason I was banging the table on cash all last quarter basically, was because it's hard to sell in a down market. It was real easy for us to sell when every idiot was buying at the top. Then we had no problem at all liquidating every position we felt like selling. Everybody wanted to buy whatever we were selling. No worries at all. Now, it's hard to sell something and get a decent price. Everything you try to sell, nobody wants it, or immediately you try to sell it and it starts going down in price because you're trying to sell it. It's hard to sell things when people are panicking. That's why you try not to. But the only way you can learn how to do that is to learn not to be greedy. Don't be greedy at the top. Don't be too panicky at the bottom. It's a tough discipline to get to. So Steve said, what about the OP? I assume you said that before. I just talked about it. No, it's not balanced, and it's a big problem. We have to fix that. I don't know if I want to fix it today. I think we might have to fix it today. I don't look at where we are. Can you show how to calculate and enter a 50% hedge position? I'm not sure what you mean by that, but let's... Oh, I see. You're talking about the one I was talking about in the OLP. All right. That is worth discussing. Well, in our short-term portfolio, it doesn't matter what it was. But in the short-term portfolio, we had a trade where we took 50 SDS something and did something with it. Hang on a second, let me see if I can find it. Well, oh, that's right, I can find it here. Short-term. So the short-term portfolio, by the way, it really can't move much because it's almost all cash. These positions are almost irrelevant. This SDS certainly covers all these positions. What was I going to say? Oh, yeah. So, oh, that's nice. Look at that. See, we sold these 340 puts and got a great price for them. So our play was we took 50 of these bull call spreads, 22-27 bull call spreads, right? And they cost nothing because we took them when they were out of the money. When we took them, the SDS was barely, maybe a little bit below 22. And it was only like a few days ago, like 28. Well, actually, it's like 2 weeks ago. There's the 8th. There it is. So going into the weekend on that Friday, we decided we needed something to hedge the STP a little bit further. We took these SDS positions, 50 of them. We only spent net, what, $4,200, $4,250 on this position. Okay? But we offset it by selling these. It was the same day. We sold the Apple $80 puts. Now, at the moment, we're losing money on the Apple 80 puts, but that's not relevant. You know, we really wouldn't mind owning 500 shares of Apple for $80, $40,000 total. That's not a problem for us. It's not like we're not going to lose sleep at night worrying if we're going to end up owning Apple for $80. So in other words, this $4,500 completely pays for these $55 spreads. So we have $25,000 worth of protection that we essentially paid nothing for. The only thing we paid for it is that we promised to buy Apple for $80. All right, so that's like if you see a Tesla, which is 85. You know, let's say Tesla's $80,000, and you say, well, if it's $60,000, I'll buy it. And then somebody says, okay, here's $4,500. Thank you for promising to buy it. All right. So what's going to happen to you? Is the $4,500 free, or is it $4,500 that you're obligated to? Your only obligation is to buy something you want anyway for a cheap price. That's all a put is when you do this. I'm selling a put on Apple saying if it gets to 80, I'll be the idiot buying it. Okay? So if you consider that, it's all a matter of how you look at it. But yeah, there is some margin cost to this. You're going to get, depending on your portfolio margin or whatever, you'll get charged a few bucks to have. And this in a normal portfolio, maybe $16 at the most. So you'll have some margin requirement on it. But the bottom line is that you're collecting $4,500. You're paying for the spread for free. That's how we like to do it. So even now, this spread, which started out at 80-something cents, is only like $1.50 now. So it's not like it went up a lot. But we could set up a similar kind of spread. And in fact, we will set up a similar spread for the options portfolio. Now let's see. In the option opportunity portfolio, I need as I said, well, we need a $50,000 spread, but it doesn't have to be $50,000 spread now. Was it the S&P that was still high? Yeah, the S&P and the NASDAQ is still high. When you need a $50,000 worth of protection, you don't need to get it all in one shot. You just need to have it. If you cover the first 25, then as soon as you're halfway into that, you can cover the next 25. You follow what I mean? So no, there's no reason to completely commit to that kind of money all up front. So meanwhile, so let's say our worry is that the market collapses. If the market's collapsing at the pace it's collapsing now, it's going to collapse by net before March, right? So we don't need a long-term protection. Shorter-term protections are cheaper. At the moment, SDS is at 24. And see here, these $23 calls are $277. And they're not, though, because it's obviously not too. So here's 260, here's 275. So let's say 265. Or 270. Let's be conservative and say they're going to cost $270. Now let's find something. So those are the 24s, and the 29s are $1.10, but let's say $1.05. So 270 minus 105 is 165. So the net of this spread, which is already in the money though, don't forget, this is in the money. The net of this spread is $1.65, and we have $5 of protection. So basically, if we want to get, let's say $25,000 worth of protection, we need 50. All right, let's keep it simple. We need 50 of these hedges. 50 of these hedges at $1.65. Is that what I said it was? $1.10 minus, yeah. So 50 of these hedges at $1.75. Mr. Calculator, please. 50 times 165 is $8,250. Wait, what? Really? I mean, I guess it is. 165 times 50. $8,250. So that's going to pay us back $25,000 if all goes well. So now the question is, what do we want to buy? What do we want to sell that'll bring us at least some of that money back? So I'd like to at least sell $4,000 worth of something. All right, so now the question is, if the S&P drops 20%, what are we willing to commit to? But what we should do is look at our positions that we have now and see if there's anything we want to offset or that we should be looking at to cover. So we already have these guys. That's costing us a lot of margin and everything else. We've got Netflix puts. That's left over from the spread that we used to have. We have Williams-Sonoma. We have ABX. We have BHI. BHI. There's one. All right, so now, boom, I found it. Baker Hughes. I love Baker Hughes. I love the short play on Baker Hughes. Let's take a look at adding 4 more Baker Hughes puts, and we'll find out what we can sell. So what can we sell in Baker Hughes? And, well, I'm going to make it simple because we already have the January 50s. I still believe in this trade. I still think I know it's hard to say at 38 that it's probably going to work out. But if you look at Halliburton, yeah. I lost, yeah, there it is. If we look at Halliburton, they're at $27.95. Ah, great. You know, I was fine until since last week I've been great with my voice, and now it's going again. Anyway, so 27.95 times. Don't forget, this is a complete collapse in the oil sector that's going on right this minute. So the worst possible time to be buying, or the best if things turn around. But it's a share of Halliburton, 1.12 shares of Halliburton, plus $19 in cash is $50. So with Halliburton at $27.95, if the Baker Hughes deal goes through, and January 25th we're going to get an update. So this is going to be a big deal on January 25th. If Baker Hughes deal goes through, then those puts are going to expire worthless. All right, so since we already sold 6, we may as well sell 4 more. And if we can sell 4 more, that's 4 times $16 is $6,400. So for $6,400 or whatever the actual price is at the moment, we can collect that money and sell the puts. And now we have the call spread, where again it's the same concept. It's like all we're doing is obligating ourselves to buy a few more BHI, 400 more BHI at $50. That's all the obligation is. And think about that, because we're collecting 16. Right now it's negative 12. If it closed right at this price, it'd be $12. We'd have a $12 loss. So really, even if it drops 4 more bucks, which is 10%, if it drops 10% more, then we owe $16, and that's all we're doing is giving the money back. So it's not really a heavy commitment. So that could be our offset on this sale, and then we can have another $25,000 worth of protection between now and March, just in case everything falls apart from here. I don't want to do it today. Today, our whole premise at TSW in the member chat, we've been discussing this for 2 days now, our whole premise is that what's driving this entire sell-off globally is that people don't take into account the fact that the February contract of oil expires today. And what happened is these traders are caught with all these oil contracts that there's absolutely no demand for, and they're dumping and dumping and dumping, and they had no time left, and so they completely dumped out at insanely low prices today. But if we're correct, then 27.50 on the new contract should hold, and if 27.50 holds and we build back to 30 by the end of the week, I think this whole area is going to snap back pretty quickly. So that's why I kind of like that one for the offset. Can you show how to calculate interest? So that's I hope you get the idea of that, what we're doing there. And then by the way, so then if things start falling apart and getting worse, what do? We just add more bull call spreads, because we will spend only net $2,000 to get the first $25,000 in protection. So we quickly spend another $5,000, get another $25,000 in protection, and now we're spending $7,000 to get $50,000 in protection. Is it a good time to short EWJ now? No, it's too beaten up, unfortunately. I've looked at those. I looked at FXI too. It's tempting, but it goes back to the same things. Like, how long have we been talking about how bad Japan is and how bad China is? The only thing that's happening now is the rest of the world is catching up to what we knew 6 months ago, a year ago. All these things that we've taken into account when the reason, look, on the big chart is where's today? Is today up here? Jean-Luc puts up a big chart in the morning. Here you go. You see these lines? These are what we consider the fair value. The must-hold line are the lines that have to hold for us to be bullish on the market. When 3 or 5 are not holding, we're not bullish on the market. And we're not. We're bottom fishing a little bit, but that doesn't make us bullish. We're not taking aggressively bullish positions. These lines have been the same for 2 years. So 2 years ago, we were kind of bullish, because if you go back to, all right, let's look at the S&P here. SPX. Okay? So 2 years ago, this is when we changed the big chart, back in the fall of 2013. And actually, we weren't that bullish, were we? So in the fall of 2013, we said 1850 was where we thought the S&P should be for the next year. And what happened with the S&P is it was here for most of the year. 1850 was a very fair price going along this line. But then all of a sudden, here, and this is a QE thing, it popped on the QE. Now, people asked me back here, are we going to change the big chart for next year? And I said no, because QE doesn't make, the way they, not that QE doesn't make anything better, but it's the way they were doing this top-down, trickle-down bullshit doesn't fix anything in the economy. If you want to fix an economy, you spend money fixing things. And that's why it's really a crime, because the conservative economists bash Keynesianism, because they say QE is Keynesian economics. QE is nothing like Keynesian economics. Keynesian economics, what Keynes says you need to do is to spend money in the economy, not give money to banks. That has nothing to do with what Keynes ever said about stimulating the economy. It's just this insane. It's this incredible thing that the conservatives take the concept of stimulating the economy, they use it to justify giving money to the banks, then they blame the liberals because the giving money to the banks didn't work. But that was never the plan in the first place. Okay? What Keynes says is dig ditches, build roads, start a war, spend money on goods and services that employ people. Handing money to a bank does not employ more people. That's why this has been a complete failure. There's nothing good about the way they're doing this. And they're taking trillions and trillions of dollars, and so is China, and taking trillions and trillions of dollars and misappropriating it. And that wrecks the economy. So, unfortunately, this whole time, I'm being a stick in the mud all year last year. I was like, no, I don't like it, I don't like it, I don't want to go long here, I don't like it, I don't like it, I don't like it. Oh, here we were right. But in August, fortunately in August, I got really fed up and told everyone, get the hell out. We can't, it's like cash everything out here. Then we went back up here, and we went back here, and I said again, cash everything out. You're freaking lucky you got back to where you were. If you didn't cash out here, cash out here. And now here we are again, back at these lows. The first time, I didn't like it. I didn't like going long here. The second time, though, we're getting a proper capitulation, and I do think we're going to form a bottom. Where? I don't know. I don't think it's never a smart idea to guess where the bottom is going to be. But I do think this is a good place to play. This is our long line, 1850. It's where we expect to bounce. Okay, and in fact, the exact numbers we're supposed to see from the big chart. What do I do with the big chart now? Here we go. So, 1850, 1942, 2035. 2100 is off the charts, right? Too high. In fact, see, this is 42 is 90. So about 90 points over here. Another 5% up is basically 2025. I mean 2125. And where did the market top out? Topped out at 2125. There it is. 2125. Exactly 5% over where we thought the top of the range would be. And all on stimulus. You know what caused it to go up. There's going to be stimulus, the Fed's going to ease, China's going to do this, blah, blah, blah. All on talk. And the thing you got to learn, if you want to be a real fundamental long-term investor, you have to learn to ignore all the talk, which in fact is funny. I said at the end of the Forbes interview, I told people to ignore the financial media, which I'm so happy they printed that. I got interviewed by Forbes over the weekend. And they actually printed my closing statement, which I never thought they would print. And I said, don't trust the media. They said, what's your biggest advice for people reading this article? I'm like, don't trust the media is my biggest advice to people reading this magazine. You can't go by what people say. You can't go by the noise on TV. You've got to come up with a valuation you believe in for the companies you're investing in. Don't let other people talk you out of things or into things. Okay, so on Thursday last week, what did we do? I went over the Dow. There's only 30 Dow components. This isn't that hard, okay? We did it with the S&P. That was harder. Earlier in the year, we did it with the S&P. And when I did it with the S&P, by the way, the S&P was at 2,100, and I said we're too expensive at 2,100 because I looked at all the S&P components. Now that we're down, I looked at the Dow components to decide whether we should be bullish or bearish last Thursday. And what I came up with, looking at every single Dow component, one at a time. This is last Thursday's post, 14. What I said was Apple, worth more than $97, should be 110. That would add 100 Dow points from where we are now. AXP should add 65 Dow points, so on and so forth. But Chevron could go lower because of bad oil. Could go lower, cost of Dow 80 points, $10 lower. So let's see where Chevron is now. Did it go $10 lower yet? This is when we bottom them. We hit the fundamental bottoms based on the number. 76, and what was it then? No, see, we're only halfway down on Chevron. We could go $5 more lower. And I said here, Chevron should be, not could be, should be 10 to 20% lower. And Exxon, same thing. Dropped 10% on Exxon, 75. So I'm saying Exxon should be like 68. Exxon, 72. We're not there yet. We could still drop another 5% in that sector. The whole energy sector, the same wipeout we're having today, we could have again tomorrow or the next day because we're not quite there at the bottom yet. But that doesn't mean it won't turn around. I'm not guaranteeing it's going to go down, and certainly I would have bet on it if I knew it was going to go down this fast. But I just looked at what I thought the fair prices were based on where we are now. A lot of headwinds could drop 10%. Let's call it 50 Dow points of damage if things get, based on where we are now. But on the whole, when I added them all up, we're good for 700 Dow points this year. That's not much. 700 Dow points is only, we should know today, it's 4%. So basically, I only think we're good for about a 4% variation from our must-hold line. All right, so in the course of the year, on the big chart, so not the must-hold line, but where we were on Thursday, which was 16,250. So actually, it's down around here. So I don't even think the Dow's going to get back to its must-hold line this year. But on the S&P, so in other words, everybody's good for maybe 4%, 5% for the year. And that means really not much progress. We're going to have a very flat, very, well, not necessarily boring. We can go up and down 10%. But where I think the value is right about where we are. But there's nothing wrong with that. That's a great market to play. I love a flat market. I love a flat market that gyrates. You know, because we can buy these stocks, like I just showed you Baker Hughes, you can buy these stocks for such a huge discount to their true value. And so the worst thing that happens is you get put the stock at a very cheap price. And the only thing you have to guard against is a really irrational meltdown. And by the way, you know, you look at the price of things in 2008, and a lot of these energy companies, by the way, are down at those kind of prices. So you look at these prices in 2008, they were irrational. And of course they're irrational. They bounced right back. And you say, oh, well, the Fed did some stimulus and so on and so forth. But you know what? If the world starts unraveling at that level again, then the Fed's going to do their stimulus dance again. And all the big banks and whoever are going to do this. It's not like they're going to say, oh, this time we're going to let it all fail. They can't do that. They just can't. So there'll be more stimulus and more easing and so on and so forth. Meanwhile, I certainly like gold and silver here. I got to tell you that. Unfortunately, I think things started popping up while we were talking, and that means, yep, see, so we don't have any good, we missed all our chances to get in on futures. Look at that, nice pop, right? Well, I'm going to give you my little speech on why the market, maybe it's all you guys buying, but this is me, right when I start giving my speech on why things are not that bad and everything starts going up. Oil's still low, but coming up and coming over that 28 line. Here's gasoline. Wow, really? No, that's wrong. I was going to say, that doesn't make any sense. Gasoline's almost up to 102. Here's our friends at WYNN Casino, which I like, of course. You know, we did a big thing on that a couple of weeks ago. Here's the VIX coming down nicely. Apple down 95. Buy the century right here. You got to buy your Apple while you can. Even Tesla's coming back. Netflix is coming back. This is the NIKKEI. They're going to be a good long if things get right. If we start rallying, they're behind, so they're the ones to play for the lagger. Here's oil. Get them in line. Not very impressive bounce so far, right? Natural gas. Oh, almost time to play natural gas again. It's going to be a warm 2 weeks. Otherwise, I would be jumping right on natural gas at this price. It's very tempting. Oh, TLT, we did a short yesterday. We did a short that was very, very easy to pick up those puts. And I caught a top here, and it came up a little bit today, but I think we're going to be okay on that one, too. What happens, you know, 130 is our official shorting line on TLT, but we've missed it. So like the last 2 times, it went up to like 125, 127, and then fell down significantly. So this time I said, screw it, let's go in early and take a position just so we don't miss it. And that's what we did yesterday. All right, back to some questions. SCO 2.2. Oh my God, really? Wow, I haven't been looking lately. Wow. Oh, no, not Star. What's over? Wow, wow, wow. Wow, that is crazy. So what we did is we took a long on UCO. That's the ultra long oil. So the same way that, now see, SCO, unfortunately, the price of the options is insane. I would love to buy puts or do something with SCO because it's not going to stay at that price. But the problem is, unless you're really, really rich, if you want to take a January, or I wouldn't go January, let's say July. So it's a 234 now. If you want to buy a 235 put, it's $60. No, I'm sorry, it's $75 for a 235 put. Can you imagine that? 30%. Cost 30% of the price of the stock to buy a put in the stock. Now, if you want to sell a 235 call, you get $75, but I don't have the balls to do it. I really don't. Because it's up $20 today. It's just too scary and too much margin into everything else. So it's no fun. But the opposite number to SCO is UCO. UCO. So UCO is the ultra-long oil. And the same way that SCO is insanely high, UCO is now insanely low. So the same logic applies, because now, but unlike SCO, we can manage a spread with UCO. So we can go to July, and honestly I forgot which one we did, but they're at 675. So you can take the $6 calls, which are 220, and now we can sell these guys for 110, the $10 calls for 110. So 220 minus 110 is 110. So for 110, you can buy the $6 calls. And UCO can very, very easily, on a very small correction, UCO can go flying up past $10, and you're going to get paid back $4 on your 110. But meanwhile, I've got this I do have the balls to see. I don't have the balls to risk SCO, but on UCO, I'm saying I'm going to put my foot down at $30 or $27 today. I'm going to sell the $5 call, the $5 puts. Now the $5 puts are $25 oil basically. So all I'm saying here is I think oil is going to stay over 25 into July. And you know what? If it doesn't, maybe I'll lose $1, maybe I'll lose $2, but I don't think so. So I'm really happy to do that trade. So you sell the $5 puts for $1. You buy the 610 spread for $1.10. That puts you in net 10 cents on a $4 spread. You're going to make $3.90 off each dime of cash on that trade. So I love that trade. That's probably one of my favorite trades right now, in fact. And if you sell, let's see what the margin looks like. If you sell these guys for $1, that's nothing. Okay, that's the selling 10, by the way. I think I have it set to 10. So selling 10. So if you sell one, it's $45 in margin on a $400 spread. So this is a very margin-friendly play. You're only getting hit for $45 in margin per contract, plus the $1.10 cash on the spread. So $1.10 cash plus 45 plus, so it'd be $110, 100 unit thing. So it'd be $110 plus 45 margin. So let's say $150. So for $150 cash in margin, if oil goes where we think it'll go, if UCO is back over 10, you are going to get back $4 for that for $150 cash in margin. Fantastic trade. Really, really fantastic trade. I mean, I super highly like that one. That's, I would say, definitely my favorite trade at the moment, because it's silly, and the thing about it is it's nice. The chance of losing a lot of money is very low. UCO is not likely to go to 0. So even if you lose $250 on the trade, you know, that's going to be, let's say you do 10, you lose $2,500, but 10 contracts could make $4,000 for you. And your chance of losing the $2,000 is very slim, because oil would have to be like $15 in July. It's just not likely. And again, this goes back to fundamentals. If you're a fundamental trader, it's like a no-brainer. I can't imagine a scenario in which oil can be that low. I'm not saying it's going to be higher. I'm not saying it's going to be 25, 30, 40. I don't know for sure. But you know what? I think my chance of losing is so low versus the possibility of winning that it's a fantastic trade. That's the way I look at that trade. So thanks for reminding me, Pat. That's a really good one. Craig says, oil popped up to 28 on the March contract a little while ago. Could spike down into the close. Or no, that's not. It went. No, it's not 230 yet. You're right. Anything could happen into 230. But exactly what I said yesterday. Oil is going to continue down. It's going to bottom out at 230 on the contract close, and then we expect to see the front month contract go back to 30 very quickly. That's what we're looking for here. And if that happens, then all the sell-off is wrong. All the sell-off that we've seen for the last 2 days is wrong, because it was based on an oil catastrophe that wasn't real. It was only based on a contract rollover. And why we're the only people in America who know that, I don't understand. I talk about this stuff all the time, yet you listen to the idiots on TV, and not one of them brings this kind of stuff up. Not one of them talks about contracts and rolling over contracts, even though it's happening today. It's like such an important part of what's going on in the landscape. And also, but it's because they want people to be scared. They want people to trade like idiots because they can take the people pay the ads can take advantage of them. In reality, you could just get on TV and calm everyone down and say, this is how the market works. There's a bunch of guys who are stuck in February contracts and dumping them because they don't want them because Iran came online. And maybe people didn't realize Iran was coming online, but then those guys are idiots too because that's something else we've been talking about for years. Corey says, can you discuss getting a fair price on options that are thinly traded, such as IRBT? Yes, Corey. That's a great topic. We talked about that in the options opportunity thing on Seeking Alpha. IRBT. Oh, let's go refresh it. Yay, we gained 1%. Wow. All right. What was our IRBT? Here we have the 23-28 spread. Now, I'll tell you something unfortunate. It depends on which leg you didn't fill. But IRBT stopped going down. Look at that. It's one of the few positions that didn't lose money today. Gold went up. Nice position there. Best Buy didn't lose any more money. That's a good sign. SQQQ flew up. That's not what we're looking for. ABX had a good day, of course, because gold went up so much. IRBT, they stayed up. So there's a couple of things that are not falling much. Look at Hovnadian. Hovnadian didn't fall very much. You know, when things are going down on a day like today, it's a great day to look at who didn't get hurt too badly. Look at Sotheby's. Only down 38 cents. That's incredible. You got to be proud of them to actually stay afloat for the day. Lumber Liquidators, well, 30 cents is bad when you're an $11 stock, because I wouldn't call that a good thing. Here's Marvel holding up, okay. It's only 22 cents down on Taser. You know, that's what you got to look for. It's like, who's not doing so badly? UNG, obviously, doing okay. You know, when you have a catastrophic day, when the entire S&P is down 2.5%, and your guys are only down like 0.5 point, that means you've got some strength in your stock. So, unfortunately, with IRBT, it didn't really come down as much with the market. Is there a particular one you're looking to fill? That would be helpful. But let's say I'll assume that it's the $35. Wait, no. All right, the $23 calls were 920. Let's say it's that. So January? Yeah. The January $23 call. So here's IRBT. And let's find January. That's not IRBT. So now we go to the January $25 calls. So first of all, we look on our chart. I got to copy it here. Oh, wait, I think I did the wrong thing. Copy. So now I'm going to go to the chart. Okay. So, not days. Let's do hours. Let's do 5 minutes. What the hell? It's not working. Let's try it over here. That's weird. What did I do? The IRBT January 23 call. The IRBT, that's not it. Why do I have the 25? There we go. I'm like, I know it was selling for 920, so there's no way that chart was right. All right. Actually, apparently nobody's bought it since it went off at 920, which was what our call was last week. Nobody's bought anymore. This was what day? The 15th. You can see up here it says what day it is. So this is on the 15th, and it went off at 920. and 905 the day before on the 14th. I think that's when, I don't remember what day we said it, but maybe we said it on the 14th. But the target was 920. And since then, unfortunately, iRobot has stayed kind of stubbornly up. And now, oh, sorry, one thing. So now you have to look at it, going back to Thinkorswim. You look at the bid is 720. The ask is 930. Well, that's interesting. There's somebody, wow, okay. Oh, this is the 23. I'm sorry. The bid is 930. I keep getting the 25 for some reason. The bid is 930. The ask is 1007. So at the moment, if you wanted to buy it, you'd probably have to pay something more in between 930 and 1070, which would be about $10. So you have to decide what, it's 80 cents more than it was. So you have to look at that in the context of the spread that you have. You could, of course, sacrifice $2 and go here. But the way you do it is very simply, though. When you make an offer, you say, I want to buy it, and I want to buy my stock. I want to buy 10 shares, and I want to buy it for, you tell them what you want to buy it for. I want to buy it for $10. That's a limit order, never a market order, and I want to put it in good to cancel. And then you wait for the market to come to you. Now, you can't force anything to happen. So you have to be realistic. If you already filled part of it, and I think if you're the guy in the chat I was talking to before, if you already filled this part and sold these for $6 or $7, if you already sold the $28 calls, and we were supposed to have a 23-28 spread, so this is 6. If this is 10 and this is 6 on a $7 spread, the extra 80 cents is a kind of a big deal, and it's not great to have. But on the other hand, you don't want to have this spread that you're stuck with, so you sold these short. I imagine you sold the short calls. So the goal was to have a $9 spread. Or what? Well, let's see what the goal was. I mean, I have the spread here. We had 920. Oh, and we sold the 35 calls. Oh, well, there's an easy fix then. Oh, no, wait. Yeah. Oh, well, this is weird. Oh, I know, because it was a roll. I apologize. Okay. But anyway, so the point is, if you have the short 35 calls, all you have to do is make up the money by rolling the call down a little bit. That's all. So I would take the 980, and then I would adjust the short call and pick up a little bit of extra money doing that. All right? But otherwise, though, also, now, this is in the situation in which you've already sold the short call and you need to cover. You can't not cover it, because then you're doing the exact opposite of the trade. You're short on iRobot when we were long on iRobot. So in other words, what we have now is the January 23 calls. We're short the March 35 calls. We've got the March 35 short puts, so that's pretty aggressive by us. And we have the 2017 28 short puts. Oh, and the 2017 37 short call. Wow, what a confusing position this is. Really? That's weird. All right. Anyway, so I couldn't possibly tell you how this all evolved. But what we're saying is we don't think it's going to be higher than 35 in March. But we do think it'll be around 35. Or actually, this is a split. This is we sold both of these, so we think it's going to be right about 35 in March. But in the long term, our big play in 2017 is we have the 23-37 spread, and we sold the 28 puts. Is that all in the options option portfolio? Wow, that's a complicated trade for this portfolio. I don't know how we fell into that, frankly. That's some heavy targeting. But anyway, so it's a really good trade if it all works out. But on these 23 calls, these are the January 23 calls. So on the January 23 calls, you're not in a hurry. But if you sold calls to cover it already, then you do want to get yourself covered. So at worst, make up the 80 cents somewhere else. But take the coverage. Don't leave yourself naked on the wrong side of the trade, especially when it's showing strength like it is today. And I hope that helps, so you can tell me if that helps a little bit. But also make the offer and let the offer sit there, and eventually someone will come down and nibble at it. It's like when you're fishing, you got to put the hook in the water and wait for someone to do it. All right, so Corey, tell me if that worked or not, because I'm happy to show you more. That's a real important point. Sound, I don't know, can other people hear me? I assume, otherwise everybody would be saying that. Twitter, yay! Twitter is just so ridiculously cheap. It really is. I don't know what popping means, but, you know, come on, people. That's just a silly price for Twitter. Coming back a buck is not, you know, I mean, it's nice, but it's just, it's, you know, really crazy. Chatter of News Corp state now, okay, so it's a takeover. You know, when you get to this price, any kind of, you can easily have a takeover room because it's just getting silly. And again, they don't, it's not that they're making money, but they thought, oh, we didn't have Twitter in the thing anymore. I thought we did. It's not that Twitter is making a lot of money. They're not making any money, but they've got good revenues, and they just haven't fully monetized their eyeballs yet. But they've got 300-something million unique visitors a day coming to their site. That's crazy. How are you going to build that? Who's going to be able to build that up? So yeah, it does make sense for a media company, News Corp, somebody like that, because they, you know, the kind of money they're paying for Twitter, $300 million a year for 10 years, right? If you buy them, the kind of money they end up paying for Twitter, they could, that's how much they spend on advertising anyway. They don't care. It's like an ad buy for them over time. And again, I'm not saying that rumor is true. It's just so easy to start rumors because it does make sense for a big media company to buy a little thing like Twitter as a side venture. John said, so apparently the huge swap of most shorted stocks of all search. Yeah. Because once people think the things stop, you know, once people say things are going to stop going down, they suddenly better cover all the shorts that they've got, right? So those most shorted stocks, people have to cover them, otherwise they're just going to get burned. So yeah, we could easily, and that's why, by the way, I don't like getting short of this kind of market because, again, the way, you know, I don't think the central banks are done with the stimulus yet. We're just waiting for, because of Davos, nobody made any major announcements until after they all, you know, have their secret meetings and get together and talk and decide on the fate of the world this week. And then next week they'll make announcements. Recommending that UCO for the OOP. No, the UCO trade is in the OOP. I think, oh, you know what? I think I forgot to put it in there. It was definitely a trade for the OOP last week or this week. I forget. Yeah, my bad. I didn't put the UCO trade in the OOP, but it is supposed to be in there. Something like it anyway. The one I was showing you is what I see at the moment. The UCO we just went over is just what I see at this moment. The trade we officially put in the options opportunity portfolio. Well, hang on. I'll just quickly look that up because I can. There it is. Officially, the trade was 10 July 5, selling 10 July 8th of I'm sorry, yeah. It was the July 5-10 bull call spread, and at the time the price was $1.15. No, $2.15. I'm sorry, it's $2.15. And then what we sold, though, is we sold 10 USO puts to cover it. We sold the USO July 8.50 puts, and they were 110. I guarantee you can get that spread way cheaper now than we did. So ours was buying a bull call spread July 5 and July 10 bull call spread for $2.15, and then we turned around and sold 10 USO, not UCO, USO, the oil ETF, the July 8.50 puts for $1.10, and you can certainly do better than that now. But on our spread, it's a $5,000 spread that we spent net about $1,000 on. So we're going to make, you know, 4 times our money back on that spread if it works out for us. So that's, I'm not greedy at that point. If it's down to 50 cents now, yeah, I still like it. I mean, they wouldn't change my mind though. In fact, we did a small one, and we already said that we were going to get more if it goes higher. And oil hit 28.50. Wow, that was great. Damn it! I can't believe we didn't play. We should have done the futures today instead of talking about how bad the markets are. That's funny. But okay, now when you say oil hit 28.50, which one? Oh, clearly it was the new one. So the contract you're looking at 2850 is the March contract. That's CLH6. CLG6 is the February contract. It's going to shut down at 2:30, and that bottomed out. And that's actually coming back to that's 2677. So, but that's going to. I mean, look how much of a big turnaround you're going to get in the energy sector if this all fixes itself. Oh, and you want to know what the best sign is? The Russell, the thing that was the worst performer, where is it? Look at the Russell. This is what you want to see in a turnaround. The thing that was doing the worst, the index that was performing the worst, the Russell, is already back to being down just 0.5%. So the Russell's had a very nice comeback. It's back to 985. Obviously needs to get over the 1,000 line, and it still needs a lot of work. But 985 is very good progress. And the NYSE is still down more than we want to see it. The NYSE is down about 2%. So it's really the Russell, for whatever reason, is popping right back, probably because it has all those small caps and most short stocks that you're talking about. There's a lot of that in the Russell. The Russell is very devoid of energy. Somebody gave us that fact the other day in the Phil Stockwell Chapter, and somebody brought up the fact that the Russell has very little energy exposure, which is interesting. But I guess that's true, because if you think about it, energy companies by nature are not going to be small caps. You know, I mean, it's hard to have an energy company and still be a small cap. So the Russell sort of escapes that trap where the NYSE does not. So I would say that would explain why the Russell is popping so quickly and the NYSE is still dragged down a bit. But on the whole, everybody's recovering. I'm not going to call it a party yet, but we're down to minus 2%. And now what happened? See, we're down only minus 2%. Europe closed down minus 3%. They're going to have to catch up to us tomorrow. That's going to give us upward momentum. So if we close higher than minus 2%, then Asia should be happy about that. And then Europe will open. They'll have to catch up, and they'll be in the process of buying while our markets open tomorrow. So we should get a little bit more of a crest tomorrow, and then we'll see how good our bounces are. And obviously, we'll be recalculating and checking out all our bounce lines. Oh, we won't really have to recalculate our bounce lines because I assumed a 10% drop when I calculated our bounce lines. And where's the 10% drop? Right here, and right here. You know, so these are the lines that we expected to hit, and we hit them today. So we already did the calculations based on the expectation of a 10% drop. So basically, everything's just doing exactly what it should do. It's just while you're in it, this is a real hard thing when you're trading, is while you're in it, when you're sitting there staring at the thing, every day seems like a catastrophe. But frankly, if you had gone on vacation here and come back in March, we'll probably be down around here, about 2,000 or so. So, you know, you go away, you come back in March, go, market dipped a little bit. Meanwhile, other people who went through it and sat here are like, oh my God, it was horrible, it went so far down. You know, it just seems that way when you go away. But the same thing, frankly, goes for if you'd gone away here and you come back here and you say, oh, it's not so bad. You know, so what? We're even. And meanwhile, you missed all the excitement. But you didn't miss the excitement. You buy something for value, and it stays a value while you buy it. And now it's a little bit lower. So what? You buy a little bit more and wait for it to come back. You know, that's value investing. Versus, I don't know what the hell you people do when you bet on these up and down every day. It's not my thing. I hate that. I mean, I like playing the futures. It's fun. I like taking little momentum plays, but not with the whole portfolio, for God's sake. You know, it's just, it's so much more relaxing to just sit and watch. Okay, so anyway. So what time is that now? 2:17. All right, we got another 15 minutes. Any more questions or whatever? Let's see if there's anything exciting going on in the news. Did anything cause this rally is a question. That'd be interesting to find out. Is there any reason that we're rallying? Did anyone say something or do something? Oh, the REITs. Oh my God. There are incredible opportunities in the REITs. Hang on. That's something I should talk about. Is this today? No. That's today. So in member chat this morning, we were looking at some of the REITs. And I'll show you all of our favorite REITs and how horrible they all look. Here you go. Here's the ETF for the REITs, the Vanguard, whatever the heck they call it. So they're down about 10%. Meanwhile, R took a real big hit, but this is down at good support. Good support line for them. I like them. I think they're a good read. I don't know why they're trading so badly. I think they're a great bargain down here. NLY, also another good, solid performer. Good bargain down here. Chimera is a big-time favorite. As the same guys, NLY essentially runs, same management team runs Chimera. They got really beaten up. They're going to be a good price here. This is where they spiked to. And look how fast they came back from that spike in September. So this is kind of like a crazy low price that just, obviously shouldn't have been there. And it shouldn't be there now. AGNC is another one that's a decent read. This is the only one we don't have. We have the others all in our long-term portfolio. And Starwood is Starwood Hotels, like a lot of the fancy hotels. They've got a real estate trust, and it's a good, solid performer. These guys pay really good money. And Starwood's really dabbling. Starwood's got such, stellar financials, STWD. Starwood's got great financials. They're paying a 10% dividend. Well, actually, it doesn't look that good. Look, 107 million. Billion? Wait, what? I'm sorry. Apparently, they have $107 billion in debt. I don't know what that means. So, I don't know how it went from $1.3 billion to $102 billion. That would have to be explained. That's pretty severe. Oh, I see. And then they offset it with these assets. Oh, that's crazy. It's an accounting trick. Anyway, so bottom line is they don't have a lot of debt other than this wacko stuff. They have $1.5 billion in debt. They have $400 million in cash. Their cash flow is pretty good for a REIT. Don't forget they pay out all their money in dividends, so their cash flow is there. They're paying much more dividends than they're losing in cash flow. They've been buying back a little teeny bit of their own stock here. They borrow some money, but it's generally a solid REIT, paying a 10% dividend, very low PE ratio, very, very nice property. CIM is another good one, paying 14-15% of this price. NLY, another good one, 13%. ARR, they've been buying back their own stock. They're now paying 19 to almost 20% dividend on the $17 stock. And, you can take these guys and you can pick up a hedge like on VNQ. Because I think VNQ has options. Maybe they don't. Hang on, let me check. But, you can hedge the sector ETF and pick up a few of the longs on the other guys to get your dividends. VNQ. Now, there you go. They have options. So we could construct a hedge on VNQ, let's say January, and they're at 74. So let's say, wow, these are crazy spreads. I'll accept that 580 as being a realistic number. So you sell the 70s for 580. So let's say you do this. Let's say this is 1080, 580. So you pick up the 80-70 spread for about $5. So you buy the 80 puts, you sell the 70 puts for $5. Now that means that unless VNQ is over 75, that means unless the entire REIT sector is higher, you make a profit. You will lose up to $5 if the REIT sector is going very well. But you can take this as a hedge because the hedge makes 100% if all goes well. So let's say you put $5,000 into this hedge, you're going to make $5,000 if all goes well. Well, that would offset a $5,000 loss on the REIT positions you take. So let's say you take $50,000 worth of REIT positions. And now if they lose $10,000, you're going to be offsetting half of that with this put. Now, don't forget they pay at least a 10% dividend, plus they might not lose money. So if they don't lose money and they pay their dividends, you're gonna much more than offset the hedge that you take. So what I'm saying is if you take an 80-70 bear put spread, you buy the 80s, so you're bearish, you sell the 70s, net $5 on that transaction, that gives you $5 protection per contract on the downside. So that means then you can proportionally pick up some long positions that are going to pay you at least 10% dividends over the course of the year. So if you get $50,000 worth of REIT stocks, you'll get $5,000 or more, frankly, because 10% was the lowest one. You'll get $5,000 in dividends paid, so you can't lose on your short puts at all, plus some appreciation in the stock, and then plus you can sell some puts and calls and do other things to make money. All right, so I'm not going to get into the whole process here, but I mean, people who follow us know what we're talking about. There's lots of ways to make money, even if the market's fairly flat, and even in a way where you can be pretty well hedged. No. Boy, somebody thinks I'm done with my thing already. What time is it? Oh, I am supposed to be done. It's the one line that doesn't shut off. Can I recommend a new play on Annaly? Sure, well, I'll tell you one. NLY. So 850 is crazy. First of all, I want to know, here's what I want to know with NLY. I want to know how much money does it pay me? Why am I getting paid to own it and take my risk? NLY. They're paying $1.20 dividend. Okay? So question number one is, should I own it in the first place? Because if you look at NLY and you look at the puts, I can sell the $8 puts for $1. It says $1.09, but let's say it's $1. All right? That's the same as the dividend, except I get it now. You're going to get paid $1 right now, and the only way it triggers is if it goes below 8, and then you have to buy it. So you're saving yourself 60 cents of downside, and you're collecting your dividend up front. So really, it could drop all the way down to 7, and you still break even, which is what 20% down from here. So so the best way to own NLY in this case is not to own NLY, just sell the put. That's your initial position. Then if NLY goes lower, you're netting into $7, and then what do? If you own it for 7, you turn around and sell if you ended up owning it for net 7, you turn around and sell the 2018 $8 calls for $1, right? And then you would be down in net 6. And you would be called away at 8, and you'd be collecting your dividends, right? So you're in fantastic shape. You almost want that to happen, right, at that point? So what I would sell in this case, I would take advantage because the VIX is high, that makes the option prices high, and the stock is low. So with that combination, I would go out another year, and I would take $1.75 for the 2018 8s. Now, they pay $1.20 a year, so you're getting about a year and a half worth of dividends. You're not owning the stock, and now your worst case is a net entry of $6.25. So you're giving yourself a big buffer, and that's your sort of initial stake in it. So let's say you want to get 500 shares. You sell 5 of those contracts. They're going to pay you. Oh, I made the math hard. They're going to pay you whatever 5 times 175 is 500 plus 350, I imagine, about $850. So you get paid about $850 in cash, and all you're doing is promising to buy NLY if it's below 8 in 2018, sorry. So if it's below 8, then you have to buy it. So you take the money, you put it aside, you got your cash in your pocket, and you just wait and see what happens. But if it goes down that far, then basically you're getting 1/4 of your stock for free. So that's the way you want to initiate these positions, especially in an uncertain market. You don't want to jump all in whole hog. What's the alternative? The alternative is buy it for $8.60 and sell these $8 calls, but you can only sell the $8 calls for $1. That's not really much of a deal. So then you're into 760 and you collect your dividend. And again, you're better off here. This gives you a better overall deal. You're sacrificing 25% of your possible, not 25, about, let's say 60 cents. You're sacrificing about 60 cents of your possible dividends that you could collect, but they may cut the dividend. A whole bunch of stuff can happen between now and then. And also, you're protecting yourself against a pretty big fall in the stock price. So it's a win-win and very little, or you're giving up very, very little of your upside. So that's the way I would go into these. And that's how you want to look at all of these dividend stocks. Always say to yourself, gee, how much is this dividend I'm trying to get? You know, even with ARR, we're going to add some more to our portfolio because we like them. They're down to $17.50. They pay $4 in dividend. But you know what, realistically, are they really going to keep paying a 20% dividend? That seems nuts. So what if they knock it down to 15%? Is it going to, you know, would you drop stock? Well, a lot of people might. But frankly, if they drop it down to 15%, I'm still going to like them. But meanwhile, because they've been dropping so precipitously, you can sell the $17 calls here in 2000. This is only July. They only go out to July. So between now and July, you can sell $17 calls for over $2. That's the same, again, the same rate as a dividend, but you don't have to lay out any money for the stock. So that's the way you want to play these things. You always want to look to see, am I better off buying the stock or not? If I could get a great price selling the calls, I might be more inclined to buy the stock, but I can't because they only go out to July. And in this case, this is easy. I do this 235. What if we had sold the February 17th? Well, they're down to, they'd be 50 cents if they're expiring now, right? Even though it says 55, whatever. But if they expire now, they'd be 50 cents. So I would have sold my February calls, 6 months ago. Now it comes up and they're 50 cents. And I say, well, fine. So I take that 50 cents, I roll it out here. I pick up another $1.50 for the next 6 months. I still don't own the damn thing. No harm, no foul, but I just keep stuffing money in my pocket like a dividend. If it ever goes down lower, then I'll buy my stock at a super duper bargain price. If it doesn't go down, no big deal. I keep the money. I don't mind keeping the money. That's a very big cornerstone of our strategy on being in the house. It's like, get paid not to own stock. All you're doing is going around saying, you know what, if IBM goes down to 80, I'll buy it. It's like, okay, here's the money. So what are you doing? If Apple goes to 80, I'll buy it. Okay, here's $15, thanks. It's like, really? It's just amazing that this even happens. It's amazing that this is even a normal function of the market. That I just pick a random stock I like. I go to IBM. It's down at 120. And I said, well, you know what? I don't want to buy it for 120, but I'll buy it for 100. Okay, if you want to buy it for 100, I'll give you $10. I'm like, okay, I promise to buy IBM for 100. And you're going to give me $10 right now. So I promise to buy IBM for 100. You give me $10. My net buy of IBM is 90. 90 is 25% below the current price. That's all I'm promising to do. If IBM gets 25% cheaper, then I'll buy it. Meanwhile, you'll give me $10. I don't see the harm. If I have a space in my portfolio for something, that's what you should be doing. And that's how you should look at all your stocks. You should always say, how much do I get paid not to buy that stock? How much do I get paid to promise to buy that stock? Now, you don't want to overextend yourself because in a really harsh market sell-off, you could end up owning all these things. But at least you save yourself 25% of the drop. That's the key to that strategy. All right, my voice is giving out. I don't know when it's ever going to get fully recovered because this is really getting annoying. So we're going to have to see. Last question. Last question is, Giles says, how would I correct 2018 110 puts on IBM, receive 975? I wouldn't correct it. You're net 100. What's the big deal? You correct it by waiting. You can't correct it until the 2019s come out if you want to roll it. I mean, you could. There's things you could do. It depends how many you have. But you're saying you sold the 110s for $9. And now they're $14. So you feel, well, I'm down 40%, I'm down whatever on the puts. But it doesn't matter. It's only on paper. You collected $10 or $9 for the 110 calls. Your net is $100. IBM's 20% above your net. So other than worrying about what it looks like in your portfolio, which, by the way, is the entire loss of the long-term portfolio, is exactly things like this. Other than worrying about the paper loss, there's nothing wrong with the position. If IBM falls another $20, there's still nothing wrong with the position, because what do you care if you when you're in 2018? In other words, let's say you had sold the $120 puts. Okay, I'm just going to randomly go. Let's say we sold the $120 puts for now. For 2000, let's say the January's have just expired. Let's say we sold those. And let's say we sold them 2 years ago. So what has IBM done in the last 2 years? Two years. All right, well, frankly, in 2 years, it hasn't done anything bad. But, what I'm trying to say is that, things dip. And IBM's been actually had a bad 2 years. They've gone downhill pretty much. In 5 years, they're kind of equalizing to where they were 5 years ago. Here they are, right? So back in 2010, this is where they were. Now they're coming all the way back down. But they'll probably stabilize somewhere around here. 125 to 150 range is where they're going to probably end up. But the point being that you sell these puts and you look at any snapshot in any given amount of time, and it doesn't matter. See, it doesn't matter where you were. What matters is where you are when the thing ends. And things can look horrific for a period of time, but you're making a 2-year play. You can't take a 2-year play and manage it on a day-to-day basis. All right, today IBM went down 6%, but the whole market went down. And they just and also IBM just said, we're not happy with what's going on in 2015. We're lowering guidance by, I forget what it was, almost 10% or 5%, and the stock dropped fast. But the reality is they're earning $14.50 a share. That's a PE of like 8. There's nothing wrong with that. I want to own a stock that's earning $14.50, $4.20, $420. So it's a good stock. I will say, though, that if you're buying a stock, especially selling put, if you're selling a put and you aren't excited about owning IBM at net $100, if you aren't saying, oh, I'm going to get to own IBM for the stupid price I promised to own it for, if that doesn't make you excited, then you're overextending yourself with the put sales. Now, if you're not overextending yourself and you can't afford to do more, you can always. And see, I have a short here. I don't know what it started with, but I have a short here. It's at $19. I wouldn't even consider looking at this thing for another year. Even if IBM's at 100, it still wouldn't bother me. So you got your 110, and you have to always look at it rationally and say, what could I do? Well, you could double it. You could double your exposure and drop to the 90s. I'm not saying you should do that, but I'm just saying there you go. So what are your escapes? You could sell, you got the 110s, you can sell the 145s for $5 and then use that $5 to roll yourself down to the 90s, 95s. Would that make you feel better? Or would you then be worried that IBM will go over 145? And if you're worried IBM is going to go over 145, then why are you worried it's going to go to 100? But all these options are options that are available to you. If you have the 100 and, let's say you have the 140 puts now, well, obviously it'd be 20 in the money, right? Let's say you have puts to the $20 in the money now, and you had sold the 140 puts. What would you have to do? Well, you roll them something that's $20, so you would be able to roll them down $20 to the 120s. So what will you be able to do with the 110s? You'll be able to roll them to the $90 puts in 2020. And then the 2020, you'll be able to roll the 90 puts down to the $70 puts in 2022. And the bottom line is, if you, as a long-term investor, aren't going to be happy with that, then you've got to set a very tight stop on the short puts you sold because you don't really like IBM. And why the hell would you have sold a put in a stock you don't like? You've got to, when you sell a put, you have to actually want to buy the stock for the price that you're saying you want to buy it for. Because if you don't, you're not going to enjoy the entire experience. Because every time it goes up and every time it goes down, you're going to be unhappy. Whereas me, I sold the 120 puts. I don't know what I sold them for, $10, whatever. But I sold the $120 puts. And I don't really care if I end up owning IBM for 120. That was my target at the time. I want to own IBM for 120 or 110 or whatever it is. I want to own IBM for that price. So if it's down around 120, I'm like, oh great, I'm going to get to own IBM. And then what am I going to do? Then I'm going to sell some calls. And then I'm going to sell some more puts. I'm going to lower my basis some more. And I'm going to have a bigger position in IBM because I love IBM. I want to own IBM for the next 20 years. It's a big part of the strategy. If you go into it with the wrong reasons, that's when you get in trouble. And it's just, so if you're long-term, then it's not even worth looking at. A year from now, look at where IBM is. I mean, unless, of course, it's down to 80. Then say, whoa, what the hell is going on with the company? But if it's 110, if it's at 100, if it's at 90, your net is 100. No skin off your back. All right, nothing to worry about. Oh, I'm sorry. By the way, that rolling thing, here's the thing about the rolling. It's kind of important. If, however, you sold the 140 puts, they're already deeply in the money, right? And they're losing their premium. They've only got $10 in premium. This is when it starts becoming worth it to roll, because if you roll them down to the 110 puts, now you're saving 30. But see how if you roll, you would have to double it $20 lower, right? 110 to 90, you'd have to double it 20. When you get to the 140s, he doubles, but he gets $30 lower. The 150s at 40, they double, 120, still 30. So basically, you get another $10 lower if you let it go. That's the funny thing about it. If you let it get worse, your 2x roll actually turns better in your favor. Why? Because the premium of the out-of-the-money calls goes up faster than the premium of the in-the-money calls. In fact, the premium in the money calls reduces. So as it moves more and more against you, the rolls get better, not worse. And that goes for the ones to the longer dates too. So again, there's never a reason to panic and there's never a reason to go early on the trigger, because if you're a long-term investor, it's just, something happening at this moment. I mean, the hardest thing I tried to do with people in 2008, when Apple was at 85, that's why I had 85 now. In 2008, when Apple fell to $85, and I was banging the table going, buy. I mean, I couldn't believe it was possible to buy Apple for $85. I couldn't even believe this was happening. And that was 85 pre-split, which if you divide by 7 is like 12, 13 bucks, a share. So it's like 10% of where it is now. That was in 85. At 85 in 2008. The hardest thing to do is try to explain to people who had Apple at 110 why they should hold on. Or either buy more or hold on. If you're a long-term investor, be a long-term investor. You can't change your mind about being a long-term investor just because something happens in the short term. You look at your company. Of course, you look at your company and say, is the company terrible? Did I make a huge mistake? That's different. But just because the entire market drags something down and everything turns sour for a certain period of time, that doesn't make it a bad investment. And especially now, and especially in a market like this, when you're sitting here with these companies, the only thing you should care about with IBM, are they making me money? Think of IBM if it's a business and you own $120 of the business, and at the end of the year they're going to give you $14 back. That's good. That's like 12% back, 13% back on your money. What else do you want? That's a good business, right? Every year you sit there and they drop 10% in the bottom line. That's the cash register. It's going into the register for you. That's what a long-term investor has to think about, not the price of the stock. Is the business doing? It seems so basic, right? It's like, is the business doing well? Not is the price of the business doing well, is the business doing well? When you rent out a house, when you get a ski condo or whatever, a Florida or a beach condo, whatever it is, and you buy it for $100,000 and you have a mortgage and your mortgage is $10,000 a year and all your expenses, and you rent it for $15,000 a year and you're making $5,000 bucks. Do you even care what the price is of the place on a day-to-day basis? No, you rent it, and you rent it this season. You've already got to rent it for next season probably. I mean, you say, oh, what if the real estate price goes up and down 10, 15, 20%? Who cares? My expenses are this. My return is that. It's a good deal. It's a good business. And that's what you have to look at your stocks at too. Are they generating a return over time? Not what's the price of the stock today, what do other people think about it. That's irrelevant. Over the long term, if your company's making money, you'll do okay. But sometimes it can be a very long term. That's the only problem with it. All right. I'm going to wrap it up, I think. How's the markets doing? Oh, charts. Oh, Matt. Oh, look at that. Fantastic. This is still terrible. We're down 2% here, 2% here. But at least not as terrible. Which is, frankly, unfortunately what's going on every day. It's like, oh, well, it's not as terrible as it was. But meanwhile, overall, every day gets worse and worse. Nikkei's still down 5%. So there's nothing to celebrate here at all, folks. These are terrible, barely coming back from horrific losses. The only encouraging thing right now is the Russell, so they got to hold it or I'm going to start losing hope in this thing. All right, guys, great. That's it. We're going to wrap this one up, and I will do it again next week. From now on, it's always going to be Wednesdays. Always Wednesdays at 1 o'clock, all right? Thanks, everybody.